Welcome to Ask the Experts. I'm Jill Schlesinger of CBS MoneyWatch. I'm joined by
Jack Otter, executive editor of CBSMoneyWatch.com.
And big day today, Jack. We snapped a 5-day losing streak for the stock market. So we'll get to that. We also want to remind those of you who sent us all those questions about last-minute tax filing tips. We have a fabulous guest joining us in studio today. It's Fred Slater, and we're going to get to your questions. But first, a quick little overview of what happened. Jack, we were down over 4% over 5 trading sessions. And we snapped back today. Looks like Dow up 90 points on the day, 12,805. NASDAQ up 25 at 3,016. S&P 500 up 10 at 1368. Why did we sell off? What's the deal here? Please, just make it better for me.
Come on, the market was up, what, 26% off the low, and everyone got docile and thinking, oh, happy days are here again. And yesterday, people in the newsroom were coming up to me and saying, when is this going to stop? Is it going to keep on falling? As if, I know, I have no idea. But they do today. They think I'm a genius because I said, well, if it falls over 200 points today, I bet we'll see a bounce tomorrow just because that's how these things often go. So now everyone's going to probably take me at my word and lose a lot of money in the future. But I think once you're going up that long, you're overbought, as they say. And then we had a little negative news on China's growth. We had some fear about Spain, bond yields ticking up in Spain and Italy. Also, people suddenly started focusing on earnings. What do you know? And it doesn't look like the comparisons are going to be so great. So there are a lot of reasons to sell.
So what about, let's just talk about this Europe-ish situation. We had a big story on 60 Minutes about Greece, and people got a little freaked out about it. And do you think that the situation in Europe is on a path to resolution, or should we be really... should it be unlike our top 3 worries?
My crystal ball is very cloudy, but my best guess is that we're going to muddle through. I think very often with these things, it's ugly, but it's in nobody's interest to see it all collapse, except for the people who are shorting the European banks. And so I think, they fake it a little bit. They have defaults that aren't really called defaults. They force banks to hold a lot more money on their books. Growth slows. There's some austerity measures. Greece obviously is in serious trouble. Greece is not going to recover anytime soon. But I think it will be, if not okay, it won't be terrible. So no, it's not keeping me up at night. But I'm not saying there's no possibility that we could see a big collapse in Europe. There could be a Lehman-type trigger, and sure, things could get really ugly.
That would allow me to say something like this. It's an exogenous event, which makes me feel good, something that happens outside. I do think that one good thing that we are now looking at is that U.S. banks have caught on to this, have reduced a lot of the exposure. It's now a little bit more in the mainstream that, hey, Europe is an issue. It always scares me more when it's not an issue, because then it comes in really, bites you and people are surprised.
Money markets were exposed to Europe a lot, now not so much. And I saw a great stat today that BMW had exported 192,000 cars from South Carolina.
Wow.
So that shows you what a global economy, you're a German company that might be hurting in Europe, but they're doing well in South Carolina and probably selling to the Chinese.
And you did mention earnings season. Alcoa kicked off better than expected earnings.
Yeah, that was a nice surprise.
Aluminium prices, isn't that great? Let's say it like that. Aluminium, because we're British. Prices were down 9%, but hey, they made some money. That was unexpected. I think that helped markets today. As you said, earnings probably not going to be so hot compared to a year ago.
But that's no surprise at this point. It's baked in.
We had 9 consecutive quarters of expansive earnings growth. It does sort of have to revert to the mean at some point, right?
Yeah, exactly. And that actually, while I think that this particular earnings season might be priced in, some people say that the fact that we have seen record margins is not fully priced in, and that PDE ratios are actually higher than they look right now because earnings are just unsustainably high.
Another thing that on the docket today is and yesterday is the Buffett rule. So, Sally, we have a little bit of video from our president to show everybody here and see what we're talking about.
Let's go to the time when the share of national income flowing to the top 1% of people in this country has climbed to levels we haven't seen since the 1920s. These same folks are paying taxes at one of the lowest rates in 50 years. You've heard that my friend Warren Buffett pays a lower tax rate than his secretary because he's the one who's been pointing that out and saying we should fix it. The executives who are with me here today, not just behind me but in the audience, agree with me. They agree with Warren. This should be fixed. They, in fact, have brought some of their own assistants to prove that same point. It's just plain wrong that middle-class Americans pay a higher share of their income in taxes than some millionaires and billionaires.
The thing I like the most about that is the woman who looks like a cross between Debbie Wasserstein Schultz and Carole King, nodding, yes, I'm a millionaire and I feel great about it. Here's my assistant. So let's talk a little bit about the Buffett rule. I posted about this yesterday, Jack, about a look behind some of these numbers. And Sally, can you put that up on the screen for me, my lady? The thing that's interesting to me about this is that when you look at really how much money would be raised, we're not talking about big dollars, right?
Right.
And this is probably why the president is trying to say this is an issue of fairness, not an issue about I'm going to close the gap in the year-to-year budget or in the national debt. So, you know, of course I get hate mail whenever anything like this goes up. And I thought that was kind of normal, unusually down the middle of the road for me, that post, right? So I didn't even take a big opinion, and everyone is exercised about this. So what about this Buffett rule? First of all, is it going to pass?
No, not a chance.
Not a chance. Okay.
Not this time around. I think once we face the music on what we have to do with the tax code, yes, people who make over $1 million a year will end up with a higher tax rate.
And
or I should say, they'll end up paying more taxes, not necessarily a higher tax rate.
I think what's kind of interesting about it is that the idea that the president's saying he made a very different distinction today. He said, I am not talking about you people who have saved your whole lives and have $1 million. I'm talking about people who earn $1 million a year, and I want them to pay at least 30% of their income. I want them to be at a 30% effective rate.
Right.
And so it's not going to pass, but it does kind of, the vote, which happens in a couple of weeks, does sort of isolate people in Congress to say an up or down vote on that. And it could become an interesting wedge issue, right?
I think it's a clever political move. I also think there's so many fascinating issues that come into this. One thing, by the way, I don't understand, maybe you can tell me, is he talking a 30% marginal rate? So I believe it's income over $1 million would start to be taxed at that rate.
Yeah, but I
so
think
you wouldn't pay $300,000 or $330,000.
No, but what he also was saying is that I think he means your effective rate has to be at least 30% on everything, including
Why don't you call
gains.
it an AMT for the millionaires?
Okay, hold on a
instead
second.
of being 28, which it is now,
right,
being 30% over $1 million. Wouldn't
Okay,
it be
so
the same?
this is Fred Slater, who has been a CPA at MS 1040. MS is because his partner is an M and he is an S, and he tried to get SM. But the IRS didn't think it was that funny. So he's MS 1040 LLC since 2006, 25 years as a sole practitioner as a CPA. And he started working with his father on Long Island in the 70s, and yet he's wearing a New York Rangers pen. Please discuss later. He specializes in closely held businesses and the related income tax matters of business and individual, member of the relations with the IRS. He does a million things. You're very, also politically inclined because you have, this relationship with the IRS and e-filing, and you got your tentacles into it all, man.
Well, I mean, the IRS is a two-way street. I mean, working with the IRS, the idea of the committee that we work on is to make them understand sometimes what's going out on the street and to be able for them to practice and do what they want to do in a better way, and sometimes for us to know where to call to resolve the matter. It's not so much we're ever going to call them and say, hey, we need a favor, because that's just plain dumb. But, to pick up the phone sometimes and say, hey, we got something that fell through the crack. How do we get it resolved? Sometimes it's systemic, and we are able to work with them to fix it so that it goes away in a smooth way for everybody. So it's worked out over the years to be beneficial for both of us.
All right, so let's get to this Buffett rule for a second, because before we started the show, you and Jack were going at it, and I was psyched. Save it for the show. So, Jack, would you like to articulate what you think ought... So you were talking a little bit about carried interest, which is... We got into this whole carried interest thing because of a discussion of Mitt Romney's tax returns, and all of a sudden people realized that guys who run big hedge funds and private equity funds have special tax treatment. They get to treat the income that they derive as capital gains as opposed to ordinary income.
Jill, can I just correct you? It's not guys and gals that run hedge funds. It's people that are in hedge funds, and that's where Romney is fitting right now.
So I'm sorry. So the people who operate and invest in.
Correct.
That's what we got. Okay. So
well,
Jack.
a couple things. One, I think we should explain to people watching that part of the reason that the Buffett rule debate has come up is that capital gains, long-term capital gains and dividends are taxed at 15%. So if I were a trust fund baby instead of a CBS employee, my money would be invested and we would not be selling anything that we hadn't owned over a year, and I'd be taxed at 15%. And so that's how you get Mitt Romney, who joked that he was unemployed, but he has a whole lot of income, and that's all taxed at 15%. So while there are other issues of fairness we can talk about, one of them is simply the difference between salary, so-called ordinary income, and capital gains.
And let's also be clear, his return is quite proper, quite clean.
Oh, totally. Yeah. It's just because capital gains are taxed at a different rate.
Right. I mean, we're talking really about a moral issue versus a legal issue. Legally, he's
Fine.
completely fine.
Absolutely.
Yeah.
Absolutely.
Yeah.
And his
I don't
rate, by the way, is less.
immorally. I don't think he's immoral for
His
paying
rate, by the way,
what
is
he owes.
under 15. It's like 13 or 14 over the years.
Yeah. Exactly.
So now carried interest. Now my feeling on that is that I see it as a loophole even under current law, because right now if I risk my money in the stock market and I make money, I pay 15%. And the idea is that I'm supposed to be encouraged to put my money into the stock market so that it's invested and helps build the country's economy. Now, my feeling is that with the private equity guys and some of the hedge fund guys, if it really is their money that they are risking by putting it in a young company, then they ought to pay the capital gains rate if they reap rewards. But if they are working on behalf of someone else, investing someone else's money, then it's not their capital at risk, and so essentially they're being paid
Okay, so
an
let
ordinary
me stop
income.
you now. So a lot of people have money. They don't know how to invest in the market, and they go hire somebody to manage their money. They pay a fee for telling them who to invest with, et cetera, a management fee.
Right, an investment advisor.
Right, investment advisor. Now, those people are leading around, your money that you were talking about. Those people right now get taxed at 15% on their long-term capital gain. They're basically, the way you're describing it, no different than the hedge fund in this case, in the sense that all you have is you're paying a management fee, which becomes a 2% deduction on your Schedule A, and your gains and losses are on your return and reflected the same way.
I'm not talking about those guys. I'm talking about the private equity manager who uses a loophole. He takes some money in fees and calls it ordinary income, but most of what he gets are gains on the other people's money that come back to him in the form of fees.
Right.
I consider that to be the way he's paid. That's like his salary, but he only pays 15% on that.
So I'm just trying to clarify again.
Sure.
So a hedge fund issues a K-1, and the K-1 basically is the split of everyone's income that the fund made to the people that invested. Those people, as you're defining them, if I understand you correctly, they're entitled to the capital gain because they invested their money, they got their money back, and they should get the capital gains that are there, correct?
Yep.
But the hedge fund manager who's managing the money, he's not entitled to it except for the extent that he put up his own money. Is that your position?
Yeah, absolutely.
Well, here's a question for you. When I was an investment advisor and I took my salary out of the company, it was ordinary income.
Correct.
Why is it that a hedge fund or private equity fund should have his compensation treated differently than mine was?
Basically, the way they defined the carried interest at this point and the fact that the partnership, as complicated as the rules are for partnership, basically treats the money that he's getting paid the same way as everybody else's money.
Okay,
And
but honestly, like, that is baloney, because
we going moral or we going legal now?
No, I mean, legally, I never said that it wasn't legal. I think it is baloney. I think it is ridiculous. If I have a colleague, if I'm an investment advisor who owns my own firm and I put up my own capital and I take my income in terms of as a salary, because it's really the only way to do it, my fees that I take out are taxed, and the way I get paid, the way I get taxed is ordinary income. The guy who
As Buffett says, you're the secretary paying the higher rate.
Well, I wouldn't say I'm the secretary, but I'm just saying that I get paid, I get taxed at ordinary income.
Right.
Whereas the guy running the hedge fund, who's essentially doing the exact same thing as I do.
Correct.
It's the same job. But the way that they have lobbied for this rule change and the way that the hedge fund industry has protected themselves and cloaked themselves in their risk-taking and how great it is for society, it's baloney. And I don't think it's illegal, but I think it's baloney.
Well, we'll go back to the discussion we had before we started this about the carried interest definition, and the article was the Times, I think we said, right? You remembered the
Yeah,
author.
not bad by, I believe, Greg Mankiw.
I think
but
it's Mankiw.
I'm not
Right.
sure.
And basically the article tried to compare the risk of carrying the money to, and I think it's good in the sense of making your argument, that when you went out and you bought a house and you fixed it up and you sold it, that was capital gain. Well, that's incorrect. If you're in the business of buying houses and selling houses, that's your inventory, that's ordinary income. And that's kind of where the argument goes with carried interest. Carried interest right now, they look upon that as the argument made in the article, not in the way that it was originally intended in law. And I don't think you have to change the tax code here. I think all you have to do is go back and reinterpret it as the old way it used to be, and more strictly interpret it, and you will find that the carried interest as it is no longer gives you the capital gains, and therefore it changes. It's also very interesting. If it becomes ordinary income, it then becomes an ordinary deduction on the tax returns of the other people investing, which changes the whole way that you're going to look at these partnerships, because you're no longer getting it deducted against your earnings as a net. You're going to get it showing as you're going to pay the tax on the amount you paid these people as an ordinary deduction.
So that's interesting, because then it sort of changed the whole economic structure of the hedge fund and private equity business.
Well,
as both as an investor and as a manager.
Well, correct.
Right.
It goes back to, in a similar way, the argument of people saying you take away the interest deduction and the real estate deduction on a home, you will destroy the real estate market. The question I pose, and I don't know the answer, if you take it away, will you destroy the hedge fund market?
We can only hope. Let's move on here. And as she says, knowing so many hedge fund people who are so rich.
One thing on the buffer rule that I learned is that there actually is a law out there, a bill that probably won't become law, proposed by Senator John Whitehouse, that would actually not kick in the 30% until $2 million. It would start phasing in at $1 million and then and then at $2 million. I think it'll get voted down, but it's in the Senate.
Well, that given New York, I think that's a more real.
Yeah. A lot of people say to me we should have a geographic tax code where, in states where there's higher incomes, we should equalize it based on where you are. I want to shift gears here. Tax day is less than a week away, and I did find this fantastic video that might encourage you all to get more excited about tax season. So check this out.
Your country needs you. Are you a patriotic American?
Yes, sir.
Eager to do your part?
Yes, sir.
Then there's something important you can do.
Oh, boy, I'll do it.
You won't get a medal for doing it.
Oh, that's all right.
It may mean a sacrifice on your part.
I'll do it anyway.
But it will be a vital help to your country in this hour of need. Shall I tell you what it is?
Yes, what is it? Tell me.
Shall I?
Tell me what it is.
Your income tax.
Income tax?
That is from 1943, a lovely bit of propaganda from the IRS and the Walt Disney Companies. So in 1943, obviously terrible war raging, and the United States is figuring out how to help people want to pay their income taxes. They put this great video out, and we want you to pay your income taxes as well. And by the way, we're having a few problems with our chat room, so if you've got a tax question, you can send us an email to asktheexperts@moneywatch.com. But Sally, I think it's up and running, so I'm not so sure about that. So first of all, I understand that there's something like 20% of filers, 1 out of every 5 filers waits till within the last 2 weeks to file. So if you're freaking out right now, Fred, what's the calming antidote to your freaking out?
Well, the best advice I can do is try to guesstimate what you think you either owe, and if you don't owe, you're getting back, and file an extension. You get an automatic 6-month, and the title of the form you file is called automatic.
Yeah.
So it's, psychologically, at least it'll give you time. On the other hand, if you're the kind of person that you're going to keep putting it off, I'm not so sure this is good advice for you, but at least if you do approach, the fact that, okay, I got more time from the government. But caution, it's an automatic for filing. If you owe money, it is not an automatic not to pay. You have to pay in a minimum of 90% of the tax that you owe. And this is kind of a hindsight rule. So if you think you owe $10 today and you pay in $9, and it turns out you owe $12, the extension is not considered valid. And it's basically going to tax with penalties back to April 15th. So if you can, try to pay in 100% to give yourself a little more leeway.
And by the way, those penalties are rather stiff. You never want to go silent on the IRS ever, because those late filing penalties are crazy, and the penalties for under reporting what you owe is and underpaying is crazy. And it turns out to be like 5% a month, right?
It's 5% a month up to 25, then it stops, and then other ones kick on. So eventually it gets capped, but it takes a while.
It's a crazy.
We should point out that the penalty for not filing is a lot bigger than the penalty for not paying.
Yeah.
So the crucial thing. Well, excuse me. What I meant was you do it when you file for that extension. You do have to pay, but if you're off a little bit, you're going to get hit a lot less.
Well, again, if you make the 90%,
right?
Yeah.
And you do file the extension, and you're within that 10% rule, you will only owe the tax and the interest on it, and there is no penalty.
That interest is not as steep as the penalty as if you don't file.
And there's some free help for people if you're filing your taxes. There is some help, free file if you made less than $57,000 last year. You can access free file products through the IRS website. By the way, the IRS website is awesome. I think it's amazing, irs.gov. Fantastic. And
you don't often hear us say that.
Yeah.
I think there's also, if you
bureaucracy
call
with a good
311, 311, I think, has a help for New York City.
For New York people, absolutely.
Right.
And there's also a volunteer income tax assistance program. And I also want to point out that the IRS is offering some relief for those who are unemployed in 2011. And so it's going to offer a 6-month grace period on its failure to pay penalty if you have been unemployed in 2011. So doesn't mean you shouldn't file. It just means that if you're really crazed and you were unemployed, you might get a little bit of a grace period. Let's get into some questions here. What is going on in my production people who are very chatty over there? Because we hear you. We hear you over here. Okay. Orville says, pray tell, what deductions are available for refinancing a home? First of all, you've got to love a question that says pray tell.
He heard you say aluminium.
Aluminium, and Dick in the chat room likes that I said baloney. Anyway, Orville's read some of the instructions, and he's unable to determine what the deductions are. So, refi, what is deductible on your refi?
Generally not too much more than you started out with, because basically all you're doing is changing the rate that you're paying. Maybe you're changing the amount that you owe, but basically that's all you're doing. So you're going to have your interest. If you incurred points, here's a catch to be careful of. You cannot deduct the points as a deduction like you did when you first purchased it. However, you may amortize the points, which is kind of like a depreciation. Basically, it's over the life of the loan. So if you took out a 30-year, whatever you paid in points, divide it by the 30 years and take that portion each year. And it keeps going until you get rid of the loan.
All right, now here's a great one. We were talking about this before the show because you want to see an accountant go nutty, ask him about a health spending, is it right? Health spending account, HSA? Savings account, HSA. What's an easy way to, this is from Susan, what's an easy way to account for your HSA if you're not itemizing medical expenses, but you have records showing those unreimbursed medical expenses were greater than your HSA contributions? It's so damn complicated to read the instructions. Fill out Form 8889. I wish we didn't even have an HSA.
Can I second that? I wish they didn't have one either. I hate them.
Really?
As from an accounting point of view.
That's amazing.
They're really a lot of paper. They really don't save that much money overall. And the cost from the employer side generally is quite severe. The real way they make money is not on the individual employees. They make money for the employers who take one out for themselves and don't spend it, because then you can change it over later if you keep the money accumulating. That's the only place it really makes money for people, and that's basically for someone that doesn't need one. The bottom of the form, by the way, has both the amount you took out and the medical expenses that you paid them with, and that should zero themselves out and take care of their question.
For someone who's young and healthy and has a decent income, do you like them? I mean,
you're just going to leave the money in there?
Right, right.
Then you're like the employer, yeah. But basically, it's like 5-10 years of doing it, accumulate some money,
Right.
and then
It's like a Roth IRA for the doctor.
kind of.
That's interesting. By the way, on MoneyWatch.com, we have a whole section, cbsnews.com/taxes, your taxes. And we've got all sorts of fun stuff here, articles and planning stuff and, top overlooked small business tax deductions and all this fun stuff. So you should check that out.
Just launched today, this page. We're very proud of it.
Just launched today.
At cbsnews.com/taxes.
Excellent. Raymond wants to know about his ability to write off his IRA contribution if he's got a 401k. I happen to pull up this on the IRS website, irs.gov. And Raymond, if you are single and you make less than $56,000, you can write off you can take the full deduction for your $5,000 IRA contribution. But that does get phased out if you're single. You don't get the full deduction if you make more than $66,000. If you're married filing jointly, if you make $90,000 or less and you have access to a 401k, you don't have to be using it, but if you have access to it, the IRS is counting it, okay? If you make less than $90,000 and you're married and filing jointly, make less than 90 grand, write off the full 5 Gs.
Well, see, this area of the law is what it's my own personal pet peeve. A lot of the good sections of the tax law, putting away an IRA is, especially when you're young, is one of the best things. If you can somehow have an IRA and put away have a 401k and put away an IRA, that'd be wonderful.
Right.
It's great for everything, and yet you notice how when you hit $56,000 single, no more.
Right.
It
seems crazy.
Right. It's counterintuitive. There are a lot of, and not just this, there are a lot of laws that sound wonderful when the politicians pass them. But when you start analyzing them, they apply to such a small segment. It really, and it's sort of like the reverse, Buffett in a sense. This is kind of like, let the lower half have some advantages.
Right, and you don't have to cut it off at 56. I mean, obviously, if you cut it off at a higher threshold.
Why even cut it off? Is it not saving? Is it not helping us save? Is it not the right
and when
thing that we want to do?
counterintuitive, right?
Exactly.
Okay. Let me ask you another question, because we had the HSA question. A lot of people, if you incur big medical expenses, like last year when you had to have your operation, right? The deduction, if you itemize, you can take medical expenses if they exceed 7.5% of your AGI. Is that
Correct.
right still?
7.5, which is kind of big number.
That is a big number.
But and they don't allow any more cosmetic surgery.
Why is he looking at me like that? I mean, first of all, look at my nose.
Because you
I
look
didn't
so
have
good.
cosmetic surgery, okay? They're mine, and this is mine, okay, everyone? We got that straight.
I'm looking straight ahead, Jeff.
Yeah, exactly. Wasps never get that kind of surgery.
So the interesting thing that from an accounting point of view is married filing jointly. One party has medical, a large medical. It is one of the few times that filing separately, married filing separate,
Could work.
does work a lot of times, because that 7.5 is what you filed here.
Interesting.
So if you had a medical proceeding, probably your income's down lower, and that 7.5 is a lower, and you might get it.
Yeah.
Can I ask one follow-up? I'm sorry, I'm jumping back
Do
to
it.
Orville here.
Oh.
Closing costs on a refi.
Yeah.
What's the deductibility, if any, there?
Oh, I wonder who's doing a refi right now.
Well, basically, your costs that are involved there are going to be, in New York, you're going to have some sort of mortgage tax, most likely, unless you're in a co-op, which is not a mortgage. You're going to have maybe some title insurance. All those things are part of your cost. They're not part of your deduction for the current year. So again, it's only the points, your interest, which you're going to get on your statement from the banks anyhow, your real estate taxes, if they're escrowing, if you're paying it yourself, you've got that separately. All the other costs are part of your cost basis. Save that closing statement for when you go sell it, if you're going to be greater than either the 250 or the 500, if it's your prime residence. So you can add that in to make sure that you minimize any gains that you might have.
So they may be deductible in the future to Orville, but not in 2012.
Well, they're definitely part of your basis, all
Right.
the
Yeah,
other
they
That's
just,
what I
they,
mean.
they just
That's what I
increase
mean.
your basis.
Correct.
Got it. Yeah. And another question about that, I got a question actually on my radio show, and it was a married couple that's getting divorced, selling a house, and they have gains of just under $500,000. So if they file jointly, there's no tax, right?
Right.
Now, if they file separately, just because of the way it looks like they're going to file their returns, they still get to split that $250, right? In other words, they each get the $250.
Correct.
There's no advantage of holding off filing or doing anything around that, right?
Well, no, but again, from the question I immediately asked when you started, you say getting divorced. Does that mean they have a separation?
The document in hand, going to be signed, probably not going to be final till the end of the summer. Should we just wait till the very end of the year to, well, really the question was, should we wait till the end of the year to make it cleaner? Like with one last year of filing together, should we file on December 30th? And then by January 1st, we're all set on a different
It's not going to
track.
affect. The rule of the 500,000 is married gets 500,000. Married filing separate will get 250 each. Single gets 250.
Got it.
So that it won't matter, how it lays out in that regard, as long as they're under that amount. And if they go over, given the stock market in years past, a lot of people have a lot of capital loss carryovers that are going to be eaten up on that.
That's true. Peg asked that she says she used TurboTax this year. She noticed for the first time you can deduct the cost of magazine subscriptions and photocopies made in the process of managing your finances. Can you deduct books as well? Can you deduct the cost of a financial advisor? Is this the old has to be more than 2% of your AGI?
All those items are more
right,
than 2%
right.
of your AGI. And just curious, is it that she noticed that you can do it for the first time, or that she first became aware for the first time?
I think maybe she first became aware, because that's always been the case,
It's
right?
always
It's
been the case.
miscellaneous, right?
It's miscellaneous 2%.
One of my favorite categories for
Now, is
myself.
that true for financial advisors? So you can't deduct the financial advisor from your, say, earnings on the portfolio
No,
he
but
manages?
you can deduct the
No,
fee.
unless, of course, you're in a hedge fund.
I knew he was going to come
Wait,
back to
how's
that.
the fee different from the cost? I'm sorry.
Well, the fee is that you get paid. Let's say you pay 1% a year on
Right.
your $1 million portfolio. You
Yep.
say $10,000. Yes, you can deduct that
Oh, okay.
cost. But it has to be very, very interesting. You have to make sure that the fee is drawn from a taxable account, not a retirement account.
And here's the other lovely New York State rule. It's an AMT item, that 2%.
Yeah.
So chances of you getting it are pretty slim.
Yeah, exactly. Kathy's a volunteer for a canine rescue organization in the Bay Area. Can she deduct medical food and supplies for the dogs that I foster until they are placed into forever homes? Is this a charitable donation?
Right. Charity is one of two things in this situation. If you're giving cash to the charity, obviously that's clear cut. That's a donation. The other thing that people do is they volunteer their time and expenses are incurred. Their time is not a deduction, but the expenses incurred while volunteering, and that's what she's basically doing here,
Right.
would classify as a deduction in that manner.
Okay, that's very good.
Good news for her.
Question here. I gave a donation of $500 and a CPA said I can't deduct it. If it would, you had to give $500 to a
More information, please?
I know, more information. More information in the chat room, please. I think it has...
Well, I'll give one of two choices. $500 is the magic number on non-cash. And when it's non-cash, you need a receipt.
Yep.
You need to at least have a list of what you gave away. Generally, what we advise clients nowadays with phones, what they are, take a little picture, put it in your phone, and throw it in your computer somewhere. It's awful good proof that you gave it away.
And what if it's cash? Like literally, what if it's you gave cash to somebody on the
You've
street?
got to be able to establish over 250 with a receipt back from the other side. So there's an issue. It's created with the religious. How to say, the churches, the synagogues, whatever.
Yeah.
They, where they quote unquote pass the hat. That's not a deduction in terms of the IRS looking at it. So what they've done is made arrangements so that the institute knew who was paying it, so they could at the end of the year write a letter back and account for it.
You make a pledge and put it in the envelope. And,
Right.
Yeah. Toss it in.
Marlo wants to know, is it okay to have and declare rental income loss or a single family, I think she means on a single family home, multiple years in a row? I'm thinking, yeah, because if it's rental property, you want to show
Well,
a
she's
loss.
mixing up apples and pears. There's a rule that says if you run a business,
Yes.
that you can't run losses more than 2 years in a row. It's not quite the rule. What it says is after 2 years, the presumption of running a business for a profit is no longer there, and you have to establish you are trying to make a profit. Real estate, by definition, is passive. It's not a business as
Right.
such. Therefore, and basically, that kind of loss, most likely, 90% chance, is being created by depreciation, which is non-cash.
Right.
So there are a whole bunch of mitigating circumstances here, but it's kind of expected that you get a deduction for the rental. Caution, it's passive, which means that you have to have less than $100,000 of income to be fully deductible, up to $25,000. Once you get past that, it ranges out over the next 50, and then you won't see it. You don't lose it. You get to keep records and carry it forward on a form and allocate it among more than one rental, or if it's just the one, that's fine. And when you sell it, it's very interesting because
Then you've got to recapture all that depreciation.
Depends if it's straight line or not. It's not that you're recapturing; it's taxed at a different rate than the capital gains.
So it's 25%?
Yeah.
I can't believe I remember
Wow.
half this crap.
You think that our tax code is a little complicated?
Let me ask you something about
I like employment acts.
He loves this. Well, let me ask you something about depreciation. Let's say you don't take it. It doesn't matter. The IRS is saying you can take it. If you don't
Correct.
take it, when you sell it, there's no effect. You haven't claimed it, so there's nothing.
The
Right?
law, I'm trying to remember the exact phrasing, but the law basically says that available. It doesn't say taken.
Right. Okay. Now, oh, by the way, Dick, I'm so sorry that I didn't answer this. AGI is adjusted gross income. It's the bottom right-hand corner of the front page of your return. Is that right? Yeah.
Correct.
It is. Okay.
So it's your income after you've taken deductions like your 401k and other such things. Yeah.
Well, 401k is netted off
Net.
on your W-2, but it's the adjustments for one half of your self-employment tax. It's adjustments for a IRA, which are all the shorted items on the bottom left of the return.
So, last thing before we finish up, if you don't have the money to pay, okay, this is like a big question. You don't have the money to pay, and you're whatever. You can do some things with the IRS, which is great. You should go online and look at this because you can make applications to get like 60 extra days to pay and all this. But if you really can't pay, what do you think about these IRS installment plans?
They're making them easier. I think the top is now $50,000. You can set up if you set it up. I'm not sure if it's a year or 3 years now on the payout, and there are ways even to extend that if you know how. But basically, as long as you're going to make a system to pay them, they're willing to work with you, and that's fine. And I think that's what you got to do. My attitude is because I get at least 1 or 2 a year where I'm filing 6 years backwards.
Oy.
And people are like that. That's fine. I'm not judging here. I mean, there's a group of people that don't file that say, here, I've over withheld, keep my money. And, I kind of agree with them in a sense. If you're willing to do that, if you're willing to give an interest-free loan to the government,
Right.
Are you really breaking the rules? New York State says you are, but the IRS is kind of understanding a little better on it. You can work out payment schemes, get them back in the fold. That, to me, is the way and the most important thing, to get people, not feeling like you can't call up the IRS and you can't work it out with them. To keep them in the fold is so much more important than to get them out there where they start running underground, and that's not going to help anybody.
No, it's not. Well, don't forget you have a couple of extra days this year, April 17th, Tuesday, because Sunday is the 15th. Monday is that fabulous holiday in Washington, D.C. called Emancipation Day. Thank goodness for Emancipation Day. Gives you an extra day to file. So go out and file your returns, and if you need some help, go to cbsnews.com/taxes. Lots of resources. We want to thank our esteemed guest, Fred L. Slater. What's L stand for?
Lawrence. Ugh.
Why? We are delighted that you came here. Next time, make sure you don't wear that pin because your hostess is not a Rangers fan. She's an Islanders fan. Just remember that next time.
You don't want tickets then, I gather.
I definitely don't want tickets. I would get bounced out of my family. Jack, do you have anything to say about the NHL in this moment?
I
don't
sort of
care.
grew up as a Rangers fan.
Whatever,
I remember
you're from New York City.
in
It's fine. This guy's from Long Island. He should not be a Rangers fan.
yeah, there's something strange about
raised
that.
in
Although
Queens.
then again, maybe he met Charles Wong once, and
That's me. Thank you all so much for watching. If you've got questions for Ask the Experts, or if we didn't answer a question today, give us a shout. Ask the Experts at MoneyWatch.com. I'm Jill Schlesinger.
I'm Jack Otter.
And we will see you next week on Ask the Experts.